Hey, future investors, John here from Exodus Capital. Today I'm calling myself out and challenging you to master the 5 essential investing tips every beginner must know. I've seen these mistakes firsthand. Some I even made myself before I knew better. This isn't to scare you off, but to arm you with the knowledge to spot these traps from a mile away. Investing can feel like a minefield when you're starting out, but by understanding these 5 blunders, you'll be way ahead of the average beginner. Stick around till the end for a real-life success story that proves you don't need thousands to win at this game. Let's jump in. Mistake number 1, jumping in with no plan. Imagine building a skyscraper without a blueprint or driving cross-country with no map. Chaotic, stressful, and expensive. A financial plan is your investing roadmap. Without it, you're just gambling. You see a stock flash green, hear a buzzword, and throw money at it because it feels right. But your gut isn't a financial advisor. Your plan should outline your goals: retirement, a house, or just growing wealth. These goals shape your risk tolerance and investment choices. If you don't know why you're investing, you'll make emotional decisions, chasing hot stocks, panic selling, and losing money. A retirement investor can ride out volatility. Someone saving for a house in 2 years needs a safer approach. Write down your goals, timeline, how much you can invest, and your risk comfort level. Be honest. Without a plan, you have no benchmark for success and end up comparing yourself to others or chasing unrealistic expectations. Your plan filters out the noise, helping you focus on your long-term objectives, not the latest hype. It keeps you from making impulsive decisions driven by fear or greed. Investing sporadically based on whims leads to a messy, inconsistent portfolio. The first step, create your investing plan. Define your why, how much, how long, and what if. This isn't busy work. It's the foundation of your financial future. Don't skip it. Seriously, don't be the person who dives in head first without checking the water. A little planning now saves a lot of pain later. Your future self will thank you. So, before you buy anything, make a plan. It's the smartest move you'll make as a new investor. Let's move on to mistake number 2. Mistake number 2, investing based on hot tips from your barber, gym buddy, or some random internet guru. Your barber is great at haircuts, not financial advice. Taking stock tips from unqualified sources is like asking your plumber to do surgery. These hot tips come with hype, no research, and lots of risk. FOMO kicks in, you jump in, but you don't know the company's financials, risks, or even what they do. This is how people get burned. Most tips are rumors, speculation, or even pump and dump schemes. If getting rich was as easy as a barbershop tip, we'd all be millionaires. Don't outsource your financial future to someone with no expertise. Would you buy a house based only on your barber's word? No, so don't do it with your investments. These tips often focus on penny stocks, lottery tickets with huge risks. Survivorship bias makes you hear about the one winner, not the 99 losers. Instead, learn to analyze companies even at a basic level. If a tip sounds too good to be true, it probably is. Use tips as a starting point for your own research, not the end. You're responsible for your money. No one cares more than you. Your future self will thank you for not betting your retirement on a barbershop rumor. Let's talk about mistake number 3. Don't let FOMO drive your decisions. Going all in on a single stock like you're at a Vegas poker table. It's tempting to bet big on a company you love, but putting all your eggs in one basket is risky. Diversification means spreading your investments across different companies, industries, and even countries. No matter how confident you are, things can go wrong. Lawsuits, scandals, industry downturns. If all your money is in one stock, a single event can wipe you out. Think of diversification as building a stable pyramid, not a wobbly Jenga tower. Emotional attachment to a stock can blind you to risks and make you double down when things go south. Diversification lets you benefit from winners while cushioning the blow from losers. You might not hit a home run, but you'll avoid devastating losses. Even the biggest companies can fail. Remember Enron and Lehman Brothers? Don't bet your future on one sure thing. Spread your bets, diversify, and protect your capital. Investing isn't a casino. It's a long-term strategy for building wealth. Resist the urge to go all in. Your future self will thank you for playing it smart. Diversification is your safety net. Don't gamble with your financial future. Let's move to mistake number 4. Remember, steady wins the race. Don't chase excitement, chase stability. On to the next pitfall. Mistake number 4, freaking out every time the market dips a little. You see red in your account, panic sets in, and you're convinced it's the end of the world. This is emotional investing, and it's a recipe for disaster. The market goes up and down, dips and corrections are normal. Expecting only gains is like expecting sunshine every day, unrealistic. Panic selling locks in your losses and makes you miss the rebound. The winners are those who stay calm and stick to their plan. Wealth building is a marathon, not a sprint. To avoid emotional investing, set realistic expectations and revisit your plan. If your reasons for investing haven't changed, a price drop shouldn't change your strategy. Market dips can be buying opportunities. Think of them as sales. Limit how often you check your portfolio if you're prone to anxiety. Educate yourself on market history. Downturns are always followed by recoveries. If you're constantly stressed, your portfolio might be too aggressive for your risk tolerance. The best portfolio is one you can stick with through thick and thin. Next time the market dips, take a breath and remember your long-term goals. Don't make impulsive decisions. Emotional roller coasters belong in theme parks, not your investment strategy. Stay calm, stay disciplined, and trust the process. Your portfolio and your sanity will thank you. Let's wrap up with mistake number 5. Don't let fear drive your investing. Keep your eyes on the long game. Mistake number 5, ghosting your investment account and hoping for the best. Set it and forget it is good, until it becomes set it and never look again. Your portfolio needs periodic check-ins and adjustments. Life changes, markets change, and your strategy should evolve too. Maybe your goals shift or your investments drift from your target allocation. Rebalancing keeps your risk in check. Selling what's grown too much, buying what's lagged. If you ignore your account, you'll miss chances to rebalance or adjust for new goals. Think of it like tending a garden. A little attention goes a long way for most. A thorough review once or twice a year is enough. Check your performance, rebalance, and make sure you're still on track. Don't obsess over daily moves. But don't abandon your investments either. Use these check-ins to reassess your plan and make proactive changes. Schedule regular review. Your financial future deserves it. Ignoring problems won't make them go away. Consistent attention can make a huge difference in reaching your goals. Don't ghost your portfolio. Show it some love. A little care now means a lot more later. Your investments are working for you. Work for them too. Let's wrap this up. We made it through the 5 big rookie mistakes. Now you know what to avoid and how to invest smarter. Even small, smart steps add up over time. Share your own investing mistakes in the comments so we can all learn together. Smash that like button, subscribe, and share this with a friend who needs it. Ready to level up? Check out our stock investing course for more tools and strategies. Thanks for watching. See you in the next video.